This man is worth $160 billion, but he still lives in the same house he bought in 1958 for $31,500. He drives himself to work, eats McDonald's for breakfast, and his idea of a wild Friday night? Playing bridge online. His name is Warren Buffett. And here's the crazy part. He made 99% of his wealth after age 50. At 30, he had $1 million. At 40, $3 million. At 50, $376 million. At 60, $3.6 billion. At 90, $96 billion. Today, $160 billion. This is the power of compound interest, and Buffett calls it the eighth wonder of the world. In 1965, he bought Berkshire Hathaway for $7 per share. Today, over $700,000 per share, a 10 million % return. But here's the twist. Buffett calls it the dumbest stock he ever bought. Why? Because buying it out of spite cost him $200 billion in potential gains. Today I'm breaking down the 20 investment principles that made Warren Buffett the most successful investor in history. These aren't tricks, they're timeless rules that work for anyone, even if you're starting at 40, 50, or 60. Let's dive in. Principle 1. Never lose money. Buffett's rule number 1. Never lose money. Rule number 2. Never forget rule number 1. Most investors focus on how much they can make. Buffett focuses on how much he cannot lose. Why? Because if you lose 50%, you need a 100% gain just to break even. Protection first, growth second. Principle 2. Buy wonderful companies at fair prices. Early in his career, Buffett bought cheap, struggling businesses. He called them cigar butts, companies with one puff left. Then he met Charlie Munger. Munger taught him it's better to buy a wonderful business at a fair price than a fair business at a wonderful price. Example, Coca-Cola. Buffett bought $1 billion worth in 1988. Today, worth over $25 billion. Principle 3. Time in the market beats timing the market. Buffett's favorite holding period? Forever. He doesn't try to predict crashes. He doesn't care about daily market swings. He buys great businesses and holds them for decades. His top holdings? He's owned some for 30+ years. That's how compound interest works. Principle 4. Be fearful when others are greedy, and greedy when others are fearful. In 2008, when the world was panicking and selling everything, Buffett did the opposite. He bought. He invested $5 billion in Goldman Sachs, $5 billion in Bank of America, $3 billion in General Electric. When stocks were cheap and everyone was terrified, he was buying at a discount. Result? Billions in profit. Principle 5. Invest in what you understand. Buffett calls this his circle of competence. If you don't understand how a business makes money, don't invest. In the 1990s, everyone was buying tech stocks. Buffett avoided them. Why? He didn't understand the business models. People called him outdated. Then the dot-com bubble burst. Buffett was proven right. Principle 6. Focus on intrinsic value, not stock price. Buffett doesn't care what the stock market thinks a company is worth. He calculates what it's really worth based on cash flows, assets, and future earnings. If intrinsic value is $100, but the stock trades at $60, he buys. That's a 40% discount. This is value investing. Buy dollars for 50 cents. Principle 7. Look for economic moats. A moat is a competitive advantage that protects a business from competitors. Buffett loves companies with wide moats. What creates a moat? Brand power, network effects, economies of scale, high switching costs. Example, Coca-Cola. The brand is so strong, competitors can't touch it. Principle 8. Diversification is protection against ignorance. If you know what you're doing, concentrate. Principle 9. Don't follow the crowd. Independent thinking beats herd mentality. Principle 10. Invest in businesses run by honest, competent managers. Management matters. Principle 11. Price is what you pay. Value is what you get. Principle 12. Read 500 pages a day. Knowledge compounds just like interest. Principle 13. Be patient. Wealth is built over decades, not days. Principle 14. Avoid debt. Leverage magnifies mistakes. Principle 15. Buy index funds if you don't want to pick stocks. Low-cost S&P 500 funds work. Principle 16. Ignore macroeconomic predictions. Nobody knows what the market will do tomorrow. Principle 17. Focus on after-tax returns. Taxes matter more than you think. Principle 18. Learn from mistakes, but learn faster from other people's mistakes. Principle 19. Give back. Money is just a tool. Use it to make the world better. Principle 20. Live simply. Happiness doesn't come from money. It comes from doing what you love. So what's Warren Buffett's legacy? $160 billion net worth. The world's greatest investor. Built Berkshire Hathaway from a failing textile mill into a $900 billion conglomerate. He writes an annual letter to shareholders that millions read. He's called the Oracle of Omaha because his predictions come true. He's donated $58 billion to charity. He pledged to give away 99% of his wealth. At 94, he still goes to work every day. Still drinks 5 Cokes a day. Still loves what he does. But his real lesson? Compound interest works for everyone. You don't need to be a genius. You just need time, patience, and discipline. Remember, 99% of his wealth came after age 50. It's never too late to start. So here's what you do next. Pick one principle from this video, just one. Maybe it's never lose money. Maybe it's time in the market beats timing the market. Read Warren Buffett's annual shareholder letters. They're free on the Berkshire Hathaway website. 60+ years of wisdom. And watch the rest of our legendary investor series. Ray Dalio, Charlie Munger, Naval Ravikant, George Soros, all linked below. Subscribe now. Let's build wealth together.